Okay, let's take a look at this equity method of accounting that asks us to compute journal entries. All right, I'll read the problem to you, which you see right up here on the top part of your screen, right? Hobson acquired 40% of the outstanding voting stock of Stokes Company on January 1st, 2012 for $251,800 in cash. The book value of Stokes' net assets on that date was $450,000, although one of the company's buildings was $62,400. That was its carrying value. It was actually worth $108,900. The building had a 10-year remaining life. Stokes owned a royalty agreement with a 20-year remaining life that was undervalued by $133,000. Now, Stokes sold inventory with original cost of $58,800 to Hobson during 2012 at a price of $84,000. Okay? Hobson still held $24,300, the transfer price of this amount in inventory, and these goods are expected or will be sold to outside parties in 2013. Now, Stokes reported a loss of $85,200 for 2012. $55,400 came from continuing operations, $29,800 from an extraordinary loss. The company still manages to pay a $5,000 cash dividend during the year, or at least it did. Okay, so during 2013, Stokes reported $51,000 net income. It distributed a cash dividend of $7,000. It made additional inventory sales of $70,000 to Hobson during the year, and the original cost of the merchandise was $43,750. All but 30% of the inventory had been resold to outside parties by the end of 2013. And with that information, we're going to prepare some journal entries. So let's start from the beginning. Okay, now you see the first entry that we're going to make. On January 1st, 2012, we need to record the initial investment in Stokes. So we debit the investment account and credit cash for $251,800. Comes from right there. Okay, then we move this off. We'll tackle the second entry. We record the receipt of the dividend. So we get the cash, and a receipt of dividend reduces our investment. Okay? Okay, let me slide that up and we'll tackle the next two entries. Okay, so now you see the next two entries which we make, and now it's the end of 2012, and we need to record the accrual of the income. Okay, so we've got to reduce the equity in Stokes. That's the $22,160. That's the amount of the loss. Okay, now just to show a little bit where these numbers come from, I put this little image of some calculations I did to help you. Okay, Stokes reported an $85,200 loss. If you take the 40%, and that should be spelled owned instead of ownwed, it's $34,008. So I know we're going to reduce the investment in Stokes by $34,008, and then we're really just allocating between how much goes to the equity account and how much gets actually recorded as an extraordinary amount. So the extraordinary loss was $29,800. 40% of that was $11,920. So that's where the $11,920 comes from. The difference between the $34,008, the 40% we're going to record as the loss in total, versus the $11,920 that we're going to show as extraordinary, is $22,160. So that's just math to come up with that amount, and that's how we come up with the dollar amounts for that first entry, or this entry you see here. Okay, now the second entry is to record the amortization related to the acquisition of Stokes. We've got a debit to the equity account, the equity in Stokes income and loss account. Okay, that's the specific account we're going to use here to record that amortization relating to the acquisition of Stokes, and then we credit the investment account as a result of that amortization. Now, how do we come up with $45,20? Well, we've got to look at what you see on this schedule here that comes down to the $45,20. Right? We paid $251,800. The percent of book value acquired would have been $450,000 times 40%. Right? There's the book value. So there was a payment in excess of book value of $71,800, and then we were specifically to identify what it was for. So we said the building which we acquired for, was it 46.5, really was worth a bit more, so we've got to take the 18,600 adjustment and amortize that over 10 years. There was a royalty agreement as well, undervalued by 133,000, right? So 40% of that is 53,200, and we need to amortize that to the tune of 2,660. So when we add those together, we come up with the total annual amortization that goes into the 4520 needed to make this entry you see here. Okay, then the next entry we have to make, also on 12/31/2012, the end of the year, would be to defer the unrealized gross profit on the intra-entity sale. So again, we're going to debit the equity in Stokes income loss account for 2916 and credit the investment in Stokes. Well, why are we doing that? Well, here's why. Because we know there was 24,300 inventory still on the books. The inventory was marked up 30%, right? That's the gross profit percentage. So I've got $7,290 of gross profit, what I call profit in inventory remaining, and we've got to reduce that. Okay, so we've got to reduce the income for the fact that we had some intercompany sales. Keep in mind, when one company sends to the other, really we need to transfer. It's really just a transfer of inventory from one location or one entity to the other. Okay, so that's where the 2916 comes from. All right, then we've got a couple more entries. We have to record the receipt of dividends. Okay, so since we get 40% of the dividends, 40% of the dividends declared is a debit to cash, and it reduces our investment account. And then we need to accrue the income, 20,400, debit to investment, credit to equity in Stokes income and loss account. Okay, now that actually is the income accrual that gets recorded on the parent's books. Okay, now just to review, there was the receipt of the dividends for 2013. Then at the end of the year, record the accrual of the income, right? The entries before that were 2012. All right, now the next couple entries should look familiar to you. We again have to record the amortization, record the amortization related to the acquisition of Stokes. So that's that 4520. We've seen that number before and where it came from. And then we again need to recognize the income deferred from 2012. Okay, now I slid the screen up so you can see how we came up with that 2,916 income deferred that needs to be recognized. 24.3 remaining at the end of the year, gross profit, 30% gives us gross profit remaining in inventory, 70, 20, 90, we own 40%, so 2,916 is the amount of that deferred unrealized gain we need to recognize. Okay, and finally we get to the last transaction of 213, and this is to defer the unrealized gross profit on the intra-equity sale. Now you'll hear me call intra-entity sales. I just call them intercompany. I don't get all that caught up between inter and intra. I know we have two separate entities and we've got transactions, okay? So we're going to debit the equity in Stokes, the income loss account, and credit the investment. Well, why are we doing that? Because we need to defer that unrealized gain. In other words, there's profit sitting in inventory at the end of the year. We need to get rid of that profit because from a consolidated viewpoint, it really wasn't a sale, right? So the inventory remaining at the end of the year was 30%. That's 21,000. I'm just going through the math here. The gross profit percentage at this point was 37.5%, so we're talking about 7,875 gross profit remaining in inventory, and 40% of that accrues to Hobson that owns the subsidiary, right, that owns Stokes. And that's how we come up with 3150, and that's this problem, everyone. I hope you found that helpful.